So today we have with us Teresa Graham. She owns and operates a public practice firm in Calgary. She works with small and mid-sized companies in a variety of industries. She and her team support clients with full cycle bookkeeping, corporate and personal taxation, management consulting, and fractional CFO services. Her goal with her practice has always been to provide more than accounting support, but rather look for opportunities to educate business owners, working together to understand the financial information to enable them to make strategic business and tax decisions with confidence. Teresa Graham is a chartered professional accountant. In addition, she has a bachelor's of commerce degree in economics and marketing and a bachelor's of arts degree in psychology. We're excited to have you here with us today, Teresa. I will pass it off to you and let you educate us on the role of an accountant in buying a business.
Thank you very much. Good morning, everyone. Thank you to Village Wealth for providing the opportunity to speak to you today. My topic, as it states, is the role of an accountant in the buying process. And the question is, do I even need one? So often I'm asked, do I need an accountant, or when should I engage an accountant? Or a new client will come to me after the fact and often respond after a few conversations, gosh, I wish I would have contacted you sooner. So the short answer is yes, you need an accountant. This venture you are on is a significant one, life-changing, financially changing. It's an investment, and as such, I always stress, money spent on investing a few $1,000s on a team of advisors that are entirely focused on your best interest is certainly better than a several $100,000 mistake once the deal is done. So what an accountant is going to be able to do for you throughout the process. I do mean throughout the process. There is certainly a pre, a during, and a post phase, and all of which are going to be critical. So with that, we'll move on. So these are the areas that I'm going to be talking about today. My approach will be fairly high level, as each one of these can be actually quite complex. I'm just hoping that your takeaway from this will be enough questions to go back to your accountant with, or to seek an accountant, whatever your situation is, when you're reviewing buying opportunities. So we're going to discuss financial literacy, different purchase options, data integrity with which you get to work with, highlights and lowlights that your accountant might offer, and then actually the now what? What do you do now? Just a second, my slides went out of order here. Okay, so the first section is financial literacy. So everyone has a different level of understanding when it comes to financials. Entrepreneurs can be experts in a particular field, but that doesn't necessarily include reading financial statements. This is where your accountant is going to come in. What we're going to do is we're going to together look at these financials and see what's been provided. When I look at a balance sheet, I'm going to be going through all the different areas. I'm going to look at what is present, what are the implications of what I'm seeing, and even more importantly, what's missing. My job is to explain that to you, and that's the financial literacy piece. So for example, if a construction company opportunity comes to me, what am I expecting to see? I'm drawing on years of experience of reviewing dozens of similar financial statements. So what does the accounts receivable look like? And is there a collection opportunity or issue here? Typically, if AR is a long sales cycle or a long cycle in the construction industry and potentially high risk, what do the payables look like? Is this an indication of vendor credit well established? Are there quality business partners, or is it just a case of not paying bills? Is this an indication of an asset, meaning solid vendor relationships are already established, which is fantastic. The company might have a solid reputation in the industry, all assets. Or, like I said, is it an indication of a problem, a cash flow concern? If, for example, a retail client comes to me, what's missing? I'm expecting to see inventory. If it's not there or it's really low, then I'm going to question why. Inventory is recorded at cost, but if it's too low, is that an indication of maybe an inability to get supplies, inability to get goods, or is the inventory obsolete? If it's too high, is it an indication of poor turnover or high prices? And therefore that could impact the margins that you're going to get. So an accountant can provide an overall health check and provide some ratio analysis that will help give perspective to the numbers that you're seeing. On the income statement side, the accountant is again going to look at where, what is there and what is missing. You hear the term often used, normalize. What we're doing here is we're pulling out the one-time events, the non-cash items like depreciation, discretionary items like management fees, and trying to find what is the true untainted daily net proceeds of this financial situation of this business. But if in this analysis, we're seeing things like there is no management fee, well, that would be odd. What does it mean that the owner isn't getting paid? We're going to ask all of these kinds of questions. The next area that your accountant can be really, really useful in is the purchase options. There's a lot of different options out here. A deal is going to be structured in a variety of ways. So the buyer and the seller may not necessarily have the same preferred outcome, which means the final purchase really is a deal of a compromise. So the share sale option, which is often heard, is more advantageous certainly for the seller. You're going to just get rid of the whole thing, turnkey. You're going to be able to utilize your lifetime capital gains exemption, if applicable, realizing significant tax savings. One thing to remember, though, is this is just not automatic. Qualifying for this exemption is a test that needs to be reviewed very carefully. So doing due diligence to ensure the seller has any lifetime capital gains exemption limit available is going to be key. I've been in situations where a seller actually assumed that they didn't have any left. They're a serial entrepreneur, they have bought and sold businesses, so they assumed that they'd run out. Well, it was a pleasant surprise, certainly when I found out that they did. But had they proceeded with that assumption, it would have definitely changed the structure of the deal, and he could have suffered significant tax liabilities that he didn't need to. For a buyer, this generally isn't the most advantageous because you don't actually want all the skeletons in the closet. Because when you buy it all, right? You may already have a corporation you may want to utilize and just roll assets into it. But when coming up with the compromise, working with your accountant, you may be able to structure the deal where working capital adjustments can be made, and that could mitigate some of these risks. The other type of sales structure is asset purchase. So this situation generally benefits the buyer because you're only going to purchase what you want. However, that does still come with risk. So your accountant is going to want to look at the specifics of these net assets. What are they? What are their remaining useful life? Is there any additional capital investment that's going to be needed to replace assets that are going to run out of oomph, if you will? So we have to plan for that. Depending on the purchase price, how much goodwill is going to be created. Other very important areas that your accountant is going to look at is who are you buying the company from? Is it an arm's length or a non-arm's length transaction? Are they a resident or a non-resident seller? These will have very different considerations. Another big area to review will be the presence of any tax losses. What are the specific attributes of each? And what are the opportunities that could exist regarding these losses? And what would the impact on the sale be if they exist? Buying a company to take advantage of tax losses is not as easy as it sounds. There are complex stop loss rules specifically designed to prevent tax avoidance created by these types of transactions. So here's where it's really critical. An accountant can provide this level of analysis and evaluation. Another area that we would dive into is data integrity. One of the greatest advantages you're receiving, of course, by working with Village Wealth is the advisory team that is looking at these opportunities and preparing some due diligence on your behalf in advance. Having said that, though, the relationship with your accountant is more of a deep dive. We're going to look at the integrity of the data. Where did it come from? Who prepared it? How many years have been provided to you? And is it complete? I have been in situations more often than not where incomplete financials are initially provided. Whole sections are missing, prepared by a bookkeeper or maybe even the seller themselves. Of course, I'm a numbers nerd. I'm a financial statement junkie. I want to see everything. I'm looking at these and I'm saying to myself, well, where's the retained earnings section? Why hasn't it been provided? Why do I want to see that? Because it's really the section that gives us the whole life of the company. It's all the net earnings of the operations after tax forever. So then I want to see, what has the shareholder drawn out of the company if they didn't take management fees? There's all kinds of things you can learn from that. And then if the retained earnings are negative, and it has been for a very long time, is this a going concern business? So maybe it's not the greatest opportunity. Another very important area that I'm going to be looking at as the accountant is compliance. There could be line items in the financial statement that indicate debt owed to CRA. This can be very telling. Again, it could be a case of poor cash management. So that's the other individual, and perhaps you're going to have a completely different way of handling it. It could be a case of just inability to pay or make these payments or payroll remittances or whatever the case may be. So is that again an indication of a potential cash flow concern? I've seen all kinds of problems here in these areas. So, one of the biggest questions is, will some of these problems follow you when you complete the deal? So we want to make sure that we are not taking over any of that stuff. Another section, and really this is kind of what I've been speaking to throughout the whole presentation, is the real strength that your account is going to bring to you is basically identifying any kind of highlights, things that are really positive, potential assets and advantages to you, and also some lowlights and potential risks, business risks. So the main theme that I want to give you is a theme of questioning. That's what we're going to do. We're going to question everything that we see, and then we deep dive and find the answers. The financial information that we receive can provide unlimited sources of questions for us. And the answers are going to be very telling when thinking about how you can be successful when you take over this new company. The previous owner's issues or problems or concerns or business risks don't necessarily mean that they're yours. So we can do some simple analysis, different ratio analysis. We can certainly look at cash flow, and that's going to be a really important one, is how are you going to finance and pay for this purchase during the initial lean years? Every new business venture is tight at the beginning, and that is a reality. So how are you going to manage that cash flow plan, cash flow requirement? Is there sufficient cash flow created within the existing operations? Or will you be faced with implementing new business strategies right out of the gate to improve the situation that it currently exists? So your accountant can also question things like the current management team or staff. So what's the talent within the company? You may have some amazing key individuals that you hope are going to be staying, If they don't, does that pose a business risk to you? What about the manager or owner themselves? If they're the key driver or key individual, they hold all the vendor relationships or customer relationships, what's going to be the impact when they step away? So, you know, your accountant is going to look at who these players are and what's the dollar value associated with them. And are you buying an asset that you didn't even realize you were buying because you're getting a great team with the purchase? And then we can look at different things like the weakness areas. So potentially AR, AP, inventory, like I mentioned before. Depending on the type of business or industry, what are our typical industry standards? You know, if it's a instant cash for service or cash for purchase business, AR isn't really an issue. But if it's, like I said before, in construction business, very long cycles, AR is 90, 120 days. How are you going to manage that? We're going to look at these potential low areas or risk areas. And what is it going to mean when you take it over? What are you going to do, and how are you going to address and mitigate these concerns and have a strategy put in place? The final, and this I guess what I would call the post-purchase phase. So if I haven't sold you on the idea yet that you should engage a qualified accountant, here's where it really gets critical. As I mentioned before, things like cash flow analysis, creating budgets, forecasts, these are all going to be extremely helpful, ensuring that you start off on the right foot. You've made a significant investment at this point. You're driven to get this business operating right from the get-go. But where are you going to go with it? What's your plan? What is your baseline to make sure you're spending in the right areas and tracking to a plan? Do you have a plan? An accountant can assess your things like your return on an investment. At what point are you going to start to see or expect to see a return on what you've invested in? Keeping in mind, you didn't buy a job, you bought an investment. So you've put down capital. You are hopefully going to see a return on your investment over the years that you own it. Ultimately, you hope to resell it and again see a return. You didn't buy a job. So your accountant can help build that landscape of, you know, when can you expect to move past these leaner years? Finally, you know, areas that your accountant can help you with would be maybe financing and funding arrangements. You know, obviously as accountants, we have a wide network of colleagues in different specialties. So if they have introductions that can be made in the banking community or lending agencies, that sort of thing, looking at, you know, what you are going to get as a funding or lending arrangement. Is it high cost? Is it reasonable? You know, things like that. They can potentially add some, you know, advice in that area. And then one last thing, and this one, you know, certainly is the huge value add in the post phase, is really helping you get set up with good internal processes, good business acumen right from the get-go. So whether it's how do I, you know, what sales cycle, how do I invoice, what infrastructure do I set up? Do I hire a bookkeeper? You know, the do-it-yourselfer thing does not go very far, very long without, you know, causing problems. Your time is better spent generating your revenue. Hiring a great team is where you're going to see, you know, the value add. But getting those processes and that plan in place right from the get-go is going to ultimately lead to your success. And your accountants can help you set that up. So just to recap, as I mentioned, I've spoken in these areas fairly high level. You know, you are entering into an amazing business opportunity, a business venture. So having a solid advisory team, investing in that team to help you through this decision is going to be key. And, as an accountant, the areas that I'm certainly going to hopefully bring value to the table is, in the financial literacy space, making sure that you actually understand the financials that you're looking at. What is valuable on the page? What is going to help you make your business decisions? Explore the different purchase options, because maybe what you think was the initial gut feel, you might find after conversations with an accountant that there's some other opportunities. Data integrity is key. You've been given financial information. That information has been prepared to look good, so we want to make sure that it's the right information that you've received, and it's prepared professionally by a professional accountant, and it is complete. We're going to highlight any business risks, any opportunities assets that you might not even have thought of by looking at these financial statements for you. And then, as I said, at the end of it is help you be successful at delivering your expertise by allowing us to deliver ours. And with that, I will turn it back to you, Liz.
Thanks, Teresa. That was great. Some real nuggets in there to help anybody that's looking to buy their first business. So we have some questions that were prepared here. So I'll just start to kind of fire them off at you, and we can have a bit of discussion. I see Steve Philipchuk joined us here. Steve, we have a small audience today, but we record these sessions and they live inside the dashboard of our buyers so that they can always access them and come back to Teresa whenever they need help. But feel free to unmic yourself if you have some questions for Teresa. I'm not sure if you guys already know each other. But Steve is a business broker. Yeah. Great. So as the buyer, what should I be asking for if it's not already presented, or know what's missing in the information that is presented by a seller?
Absolutely, great question. Typically, I'm going to want to see, or I'm going to want to recommend that a buyer is getting at a minimum 3 years of financial statements if they're available. 3 to 5 is even better, because every business can have a lumpy, bumpy year. So what you're trying to get is a good picture, a good track record baseline of how this business has been doing. It would be lovely to see that it's growing steadily year over year, or is it solidly comfortable? That's okay too. Client or accountant prepared financial statements, notice to reader. Not just a tax return. Tax returns are great, but a properly prepared notice to reader. And with that, it would be then complete. Then you're going to get your balance sheet, you're going to get your income statement, and then the retained earnings piece with it. But again, I've seen where I get a synopsis of income statement. Well, that's great, but there's so much more that I can't see out of an income statement. So I would recommend 3 to 5 years of notice to reader prepared by an accountant.
Perfect. And so you kind of mentioned the relationships that you have with lenders and how that kind of synergy works. Can you speak to that a little bit more? In regards to how is it a rally? When do each of you come in? Right. What does that look like?
Well, as I had mentioned at the beginning, really, because this is such a big investment for yourself, a big opportunity, investing in a team, and you're going to look at, evaluators, legal, accounting, broker to help you find the right business, whatever it is. Building that team right from the get-go is going to be essential, because they have your back. They've got your best interests. There's no self-interest involved at this point. Who I would probably recommend, that you're going to be exploring first is most likely the accountant and or potentially business valuator. If you've got a whole bunch of opportunities, because what you've received is someone else's work, someone else's due diligence, the sellers. So they've prepared a financial package for you that shows the best of what they have to offer, or the best, business valuation that's been done. Maybe you want to have your own independent done just to be sure. And your accountant can also pick and poke. Now, I'm not a business valuator, and that is not my field of expertise. So, that's why you want to make sure that you bring all your experts to the table. But I can pick and poke at the financials and ask those questions that you can then go to that next expert. But bringing that team together, is just, it's money well spent.
Yeah, absolutely. Giselle has a question there for you.
Great.
Hi, Teresa.
Giselle.
Hi. So you said generally you ask for, 3 years worth of financials. How has COVID impacted that?
Great question. And that's honestly why I'm thinking more and more what we're going to see is needing a longer period, because I've seen, some companies now where even my own clients, their 2020 is terrible, their 19 suffered, but their 18 and their 2021 are stellar. So that's really going to give us a real false presentation of what the company could be. Certainly valuable because it's an indication of where it may not have fundamentally been strong enough to withstand the pressures of COVID. None of us could have, prepared for this, quite honestly. But what I have seen in my own client base too is the companies that were really thinking outside the box and dynamic and could pivot, that's the word of the era right now, they came out strong. They made significant change. So we may see financials that didn't impact at all. You're also going to see financials from industries that were literally COVID protected. It didn't hit them. So yeah, I think we're going to end up having to look at more years. We're going to have to see if the baseline is really indicative of the business itself, despite maybe poor management decisions or lack of preparation or whatever. But we also have to think about the industry. Was the industry necessarily impacted? And that could also be very important, because if the industry on the whole should have fared well and this person did not, okay, well then maybe that's just this person. They poorly managed their business. Doesn't mean it's not a good opportunity for you as the buyer. Maybe this is a recovery, effort that could be amazing for you. So yeah.
Awesome. I have a question from Steve. He said, assuming a seller will be paying taxes on the proceeds of a sale, can you speak to the potential tax savings of a seller financing component?
On the seller financing, or just even the, are we talking about, sorry, Steve, are we talking about a lifetime exemption on mitigating liability, or on
Vendor financing, maybe?
Hold on. His mic isn't working, so he's been typing he typed the question to me directly.
Sorry, Steve, qualify the question a little bit so I can.
Let's see. Vendor financing.
Under financing.
Vendor financing. Yeah.
Vendor financing.
Yeah.
Okay, I see what you're saying. Okay, so basically, your question is more of, so if the seller is doing like a vendor buyout option where they're receiving funds over a period of time and then paying tax. I guess I'm sorry, Steve.
Yes. Yeah, he said yes.
Okay.
Yeah.
Okay. That's a good question. Very good question. That's going to be a tougher question for me to probably answer. Let's see. That's a great question. So really on the seller side, that is going to be one of the things that it is a significant risk, right? When you're transitioning out and you're taking, say, a vendor buyout option, you are very dependent on, that this purchaser is going to be able to purchase or pay that liability over time. So when you're recording your sale and you're going to pay your capital gains or whatever it is, you're going to have a liability for funds that you haven't yet received. However, there are tax preparations that can be made that will allow you to defer some of the proceeds received, and that's going to help alleviate some of the tax liability that way. And then I don't know. It did. Hopefully did that answer your question?
I can add to that one too, actually. Recently, Village Wealth did a project with the Alberta Community Cooperative Association, and they have included they did an exit guide, and they included some case studies of the tax implications of doing vendor financing. And there are some examples in the guide that kind of map out a few different scenarios, whether getting cash at closing or doing a vendor finance. So it's a resource that the ACCA has recently published just last month. So I'd be happy to share the link to it. Yeah. Another one we have here, Teresa, you spoke with about the multiple advisors that are sometimes included. And so sometimes we hear back from buyers where they may be challenging evaluation. Where do you see the division between, they're going to their banker and having conversations about valuation, they're coming to their accountant and having conversations about valuation. Is there need to bring in, another evaluator, or, how do you recommend managing the conversations around value? And if they're going to challenge it, what best practice?
At the end of the day, of course, with the banking community, it's about credit risk, right? They're assessing, and every bank will have a different appetite for risk. And I think it's also going to come down to, do you even have a pre-established relationship with a bank that's willing to, look at your opportunity and give you relatively decent credit terms. But certainly, yes, if you're going to take documentation to your bank, having people in your court certainly is more favorable for a bank. So if you're going to have, some or accounting prepared financials that you're going with, and you're going to have your accountant review them, we're not necessarily going to give an opinion. But we're, even knowing that you've had an accountant, assess the financials, and you've already have contingencies in plan for mitigating, because really you're trying to alleviate their credit concerns. And then certainly, if they're looking at it and they're saying being skeptical on the valuation, the price, they're not seeing a path to cash. Then certainly having another independent valuation again is worth it. Now, if that's a process, most certainly, and it's probably going to require even more information. So willingness on the part of the seller to disclose additional financial information for a evaluator to be able to do a decent job on your behalf. But again, that is going to add credibility for the bankers.
Right. Great. One other one, kind of relation to the banking terms, is, when you're doing your original analysis on the cash flow, and then a buyer explores their financing options, how do you see it where, when you're looking at that cash flow servicing the debt on a new loan, now the cash flow has changed sort of the equation in it? Any tips there for what to look out for, or what you like to see in a transaction after the term sheet's been produced?
Yeah, so I'm definitely going to want to look, at where are your sources of financing coming from, right? So there's lots of different areas. It could be private, your own funding. And so are you drawing on your own personal lines of credit? Or if it's a traditional bank environment, do you have personal guarantees? So your own personal asset, that's likely what the bank is going to want to look at is having a personal guarantee in place. They could be really, really high interest. Not sure. There's certainly a lot of great advisors out there too that really specialize in this relationship with banks, looking for the best financing arrangement. Again, that's not my area of expertise, but it's one that I would, I'm going to go to a client and say, okay, if you're financing in traditional senses, a bulk of this capital investment, your interest on finance is going to be pretty high, or it could be. And we have to figure out how we're going to pay for that. So then you're going to want to bring in, yet maybe another advisor that specializes in and can negotiate on your behalf. But I do see that, and I see it, so we're going to start a balance sheet with a massive debt right out of the gates. So I'm going to be looking at, again, cash flow. Is this operation already creating enough cash flow that I can know that I'm going to have to take X% out to pay these interest charges and principal as well as interest? Or could the principal be deferred? If it's personal, how long can it be deferred before it becomes a burden? So, I'm going to be looking at what are the terms, how long do we have to pay, where did the sources of funding come from, and then how can we manage, the spread of cash. It's always, you can buy, there's always the argument, do I just buy it already done and then I have $1 million debt, or do I do it myself from scratch? Well, okay, but it might take you 10 years to get there. So, there's definitely huge advantage to buy it already, even though knowing you're going to have this significant debt. But, we just have to manage the cash flow. We've got interest deductibility that helps us from a tax position. We just need to be aware of all these different elements.
Wonderful. No, thank you for that. Any other questions? Checking the chat. Giselle's shaking her head. Okay, great. Well, thank you so much for your time again, Teresa. Thanks for joining us, Steve. And any other tips or comments that you feel you didn't get covered today?
No, I just, it's really exciting for, buyers to have this platform, to have this opportunity, to see real, legitimate, vetted opportunities out there, and to have access, to a group of people, to help. So yeah, I just always encourage buyers, make sure you spread that wide net and bring in people to help you. And if the opportunity isn't meant to be, then great. You walk away unscathed. If the opportunity is great, then you've got just, reaffirmation that you made the right decision, and all your advisors behind you are, saying the same thing.
Yeah, absolutely. We've heard stories of, good stories of dollars being well spent, and, sadder stories of dollars being lost out on because the advisors weren't brought in at the right time. So thank you again so much for your time today, Teresa. We really appreciate your involvement and participation.
Excellent. Thank you so much.